Bitcoin crosses above $50,000 for one coin. Other cryptocurrencies have been surging too. Plus, there's a motherload of IPOs and SPACs hitting public markets at record valuations. My thoughts on speculation coming up next. Hi there, everybody. I'm DeLegge with ETFguide TV. Great to see you. Before I share my thoughts with you on speculation, just some housekeeping items. Be sure to subscribe to ETFguide TV and watch our weekly originals like ETF Battles, along with the Portfolio Report Card, where I analyze and grade your investments. And if you enjoy this channel, hit the like button and be sure to share this channel and the content with your 10 million friends. So I've got some thoughts I want to share with you on speculation. We've all heard horror stories about people losing their life savings from bad investments of whatever kind. And it's always shocking, but not really surprising, because people don't learn from history. People don't learn from the mistakes of others. And they end up making financial misjudgments or miscalculations that cause irreversible damage. Now, I'm not going to discuss the root causes of this today. We're going to have to save that for another episode, because we're going to talk about speculation, and I want to explain to you some things about what it means and give you some comparisons. I also am not going to lecture you not to speculate. I don't think it's very productive. I think it's much better that I give you a framework for financial speculation that helps you get ahead, stay ahead, and also helps you avoid blowing yourself up. So I think that's what I'd rather focus on today. No lectures, so you're in good shape in that regard. Let's talk about speculation. What is it? It's really an attempt to turn a little money into a lot, whereas investing is trying to prevent a lot of money from becoming a little. Profitable results are the end goal for both exercises, but why do profits so often elude both groups? Well, fortunes have been made speculating. Fortunes have also been lost speculating. But many more fortunes have been lost than gained through speculation. Put another way, speculation is like horse betting or like rolling the dice. It's all about a game of odds. So are you buying the next Bitcoin at $50, or are you buying the green monkey at 16 million? Google the green monkey. I'm not going to tell you what that is, but it's related. So Google it, kids. The green monkey. Whatever the case is, the odds are overwhelmingly stacked against you when you're speculating. So if you're trying to flip $2,000 into 20 grand in, let's say, less than a year, well, you're speculating. On the other hand, if you're trying to get a $2,000 return on your $20,000 investment over, let's say, a period of a couple of years, well, you're probably investing. Regardless of whether you're speculating or investing, neither comes with any guarantees of a profitable outcome. So the big question is, which activity has the better odds of investment success? So I like to think about financial speculation in Evel Knievel terms. It's a life and death, all or nothing endeavor. And during his storied career, Evel successfully completed 75 death-defying motorcycle jumps and died of unrelated causes at the ripe age of 69. On the other hand, Sam Patch, another daredevil, famously known as the Yankee Leaper, he took one too many jumps that prematurely ended his life at age 30. Now, when it comes to financial speculation, the question is, are you the next Evel Knievel or are you the next Sam Patch? Now, even if you happen to think that you're the next Evel Knievel, the reality is that any extended hot streak enjoyed by you and other speculators could end suddenly in tragedy. And that's obviously not something any of us wants to see. So let's discuss the differences between speculating and investing in a tad bit more blunt terms to help you see the side-by-side differences in terms of odds. So speculation has higher profit potential, but lower probability of a profitable outcome. On the other hand, investing has a lower profit potential by comparison, with a higher probability of a profitable outcome. In the end, some speculators will win, some will lose, but there are always more losers than winners. It's like the law of gravity. It's one of those stubborn, universal rules that none of us can escape. Now, it seems obvious none of us should speculate with money that we cannot afford to lose, but the world is full of obvious things that nobody bothers to notice, thus my repetition. So instead of giving you this dogmatic lecture about why you should not speculate, I think it's far more productive to give you a framework for financial speculation. So this is what I call the DeLegge Framework. Segregate your investment total into 3 piles. You've got your core portfolio, you've got your non-core portfolio, and then you got your margin of safety. Now, each of these piles does something independently different than the other. In that sense, they're complementary when put together. But you need to understand that the only time and place for speculating, if you're going to do it, is within your non-core portfolio. The best case scenario is that your speculative moves win money, thereby boosting the value and the profitability of your overall portfolio. Now, what happens if things don't go well? If your speculative trades blow up or if they don't work out? Well, the worst case scenario is that your speculative bets, if they lose money, will be contained, right? Those losses are contained to your non-core portfolio, while the other containers, like your core portfolio and your margin of safety, remain perfectly undisturbed and intact. Congratulations, you didn't blow yourself up. So this is a very simple framework. I call it, again, the DeLegge Framework, that I think is quite powerful for financial speculation that can not only help you to get ahead, but stay ahead and also avert disaster. So it's within this context that you should come to the very quick realization that your non-core portfolio is the only place and the only context for speculating. So if you decide to speculate, and I'm neither for nor against such ghastly propositions, this is your framework. And we're going to end today's episode with a quote from investing great Benjamin Graham, who once quipped that you must never delude yourself into thinking that you're investing when you're speculating. And there we have it. I hope you've enjoyed today's episode. I have. And I hope we've given you some powerful tools and strategies for helping you to have profitable investment results. Thank you for watching ETFguide TV. Be sure to subscribe. I'm Ron DeLegge, and we'll catch you next time.